In the third and final video of the course section devoted to IAS28, we turn our attention to situations where group members trade with the associate and the adjustments which are required when this happens. The associate is not controlled by the parent entity in the group, nor by any of the other group members, and is therefore considered to be outside of the group. Consequently, the effects of transactions between the associate and group members are not eliminated from the consolidated income statement. Instead, IAS28 requires gains and losses resulting from what it refers to as upstream and downstream transactions between group members and the associate to be recognized in the consolidated financial statements only to the extent of unrelated investors' interest in the associate. Upstream transactions are sales from the associate to group members. Downstream transactions involve sales from the group to the associate. Accordingly, what needs to be eliminated is the investor's share in the associate's gains or losses resulting from such transactions. Let us consider the following example. P, the parent entity in a group, sells inventory costing €500 to A, an associate in which it has a 40% equity stake, for €750. At the reporting date, A still holds the inventory on its books. Because the entire inventory that was sold by P is still held by A as at the end of the reporting period, only 60% of the profit is regarded as having been realized from a group perspective. The total profit generated by P on the sale is naturally equal to the difference between the selling price of $750 and the cost of sales of $500, that is $250. Of this amount, 40% or 100 needs to be eliminated by means of a debit to the share of the associate's profit as recognized in the consolidated income statement and a corresponding credit to the investment in associate within non-current assets. Please note that making the debit to the share of the associate's profit within consolidated P&L is the recommended approach despite the fact that it was P who sold the goods to A, and it is therefore P who booked the profit on the sale. If we turn the situation around and now imagine that the same goods were sold by A to P, and that they now remain within P's inventory as at the end of the reporting period, then once again the unrealized profit of €100 will need to be eliminated by booking a debit to the share of the associate's profit in the consolidated income statement. This time, however, the corresponding credit will be taken to consolidated inventory, as it is there that the unrealized profit also resides. To wrap this module up, I want us to recall that in the previous module, we made a statement about the way in which the investment in the associate is computed. This involved taking the cost of the investment, adding the investor's share of the associate's post-acquisition gains or losses, less any dividends received, deducting any impairment write-downs and making a downward adjustment for the parent's share of any unrealized profit in inventory. You should now appreciate that this final adjustment is only relevant if the transaction giving rise to the profit was a downstream sale, and the necessary adjustment involves a credit to the investment in associate account within the consolidated statement of financial position. If, conversely, the sale was an upstream one, then the adjustment calls for a credit to consolidated inventory with no impact on the carrying amount of the associate.